Hello, Tyler Judkins, Member Business Advisor with PECA. What I hope to accomplish with this video is to help PECA members better understand what is a balance sheet, how to record when payments are made for loan payments, specifically principal and interest, and then how the balance sheet and income statement tie in together. So this is a pretty simple example that we're going to go through, but hopefully it will help some of our members to better understand what's happening on their financial statements. I've put together an example. Let's say that you have saved $60,000. You want to purchase a practice, and the cost of the practice is $150,000. And in order to finance this purchase, you've decided to contribute $50,000 toward the purchase, and you're going to borrow $100,000 from the bank or the SBA. Your loan payment is going to be $900 a month. That $900 includes both principal and interest. Of that $900, $200 is going to pay down your loan, which is, we've talked about $100,000, and the other $700 goes toward interest. So how is this transaction going to look on a balance sheet? Well, what happens is you started out with $60,000 in cash, and you wanted to purchase a practice for $150,000. So that is an asset that you now have, which is a practice worth $150,000. So you can see I've recorded these two transactions here, but we still have our liability section that we need to take into consideration. So what we've done here is we've said, okay, well, we know that we owe the bank $100,000. So we're going to put $100,000 in there. And we also know that we saved up $60,000 in cash. However, we used 50,000 of that. Let's see here. We used 50,000 of that toward the purchase of the practice. So in essence, that 50,000 plus this other 100,000 went to the seller of the practice. So instead of having $60,000 in the bank, you now have 10,000. You've purchased a practice which is worth 150,000. So you now have total assets of 160,000. However, so this is what you own. That's what your assets tell you is what you own. The liabilities tells you what you owe. We know that we borrowed $100,000 from the SBA, so our total liabilities is $100,000. And we also know that we contributed $60,000 toward this entire transaction. You remember that's the $60,000 is basically the $50,000 that went to the seller, and also you still have another $10,000 here in cash. So when you're looking at a balance sheet, you need to understand that assets always equals the liabilities plus the equity. So we have that here. Here's your liabilities, and here's your equity, which is 160,000. We can see that equals the total amount of the assets. So let's just say this all occurred on March 31st. Now, for the month of April, let's assume that you did $30,000 in revenue for that month. Let's say you did $9,000 in, you had $9,000 of expenses for your cost of goods sold. That leaves you a $21,000 gross profit. Your payroll, let's say, is $7,500. And let's say other expenses, whatever they may be, are $3,800. And you also had to make a payment to the bank for your $100,000 loan. You made a $900 payment. However, only $700 of it went toward interest, as we talked about up here under this scenario. So the only thing that gets recorded on the income statement is the $700, and I'll account for the other $200 in the next section over here. So you can see that we have total expenses of $12,000. Our gross profit minus our total expenses is $9,000. Pretty simple. So now let's come to May 1st. What does our balance sheet look like? Well, we know that we have $10,000 in cash. I'm going to do some formulas here. $10,000 in cash. However, we paid $900 toward the loan for the SBA. We've already recorded $700 of that right here on the profit and loss. So the other $200 needs to come out of here, out of cash. We still have the purchase of the building, or excuse me, of the practice for $150,000. So that is still there. This is going to change, so I'm going to come back to this. Now, the SBA loan, it started out as $100,000. However, we paid $700, or excuse me, $900 payment. $700 went to the bank as interest for basically renting their money. However, they said, okay, instead of you owing us $100,000, you now owe us $100,000 minus the $200 that went toward principal, which is $99,800. The amount that you've contributed. So this is your total. So your total liabilities is obviously that right there, the $99,800. The total amount that you have contributed hasn't changed. You still have vested into this business $60,000. However, if you look at the month of April, you made $9,000 right here. So that needs to be recorded. So what happens is your cash, instead of, you started out with the $10,000, we subtracted the $200 for the principal payment plus the $700 for the interest expense. However, it increased by $9,000 because that was the profit of the business. So now you have $18,800 in cash. Well, that needs to be offset because of how accounting works, the net income amount is recorded in the equity section. This is also can be known as retained earnings. So we're going to put $9,000 in the equity section. Now, this is what the balance sheet looks like on May 1st. You can see that the assets equals the liabilities plus the equity. Here's your liabilities, here's your equity. The total of those two is $168,800. There's your total assets, $168,800. So you can see the change from March 31st to May 1st in the balance sheet. And you can also understand, hopefully, now that when you make a payment to the bank, a portion of that payment goes to pay down the loan on the balance sheet by whatever that amount is according to your amortization schedule. The other portion goes toward paying the interest to the bank. So what we see a lot of the times is the bookkeeper will record loan payment $900 on your profit and loss statement. And that's okay if they do that because typically your accountant is going to make those adjustments at the end of the year. But if you want to get more accurate and fully understand kind of where things are going or what's happening in your business, this is the correct way to record it. You would record the amount contributed to interest and the amount contributed to pay down the loan. Hopefully that helps. Feel free to email me, tyler@pecaa.com with any questions, tyler@pecaa.com. Thanks.